Good morning, everyone. Welcome to a special update for the 23rd of December. I said last week that would be the last weekly edition for the year, but it was such a momentous week that I thought I would just go again with another quick video, but one that tries to put things in perspective, I guess. So there's no question that we've now got very highly disrupted markets, and any thoughts of a Santa Claus rally are obviously out the window now. So what I want to take a look at is really just what's happened, try and put it in perspective. We've broken a key line in the sand for me, so you shouldn't really now not be net long. You should be, if anything, net short or heavily in cash. So that's at this stage, it's what we saw in January and February of 2016. It's basically a rerun. Now, whether that it gets worse from here and develops into a full-on bear market, or whether we just get this partial break for a short period of time and then the markets go back up again, remains to be seen. But certainly with the breakdown we saw last week, you now should be basically set up for more downside than upside. So 2018 saw the largest proportion of asset declines. So I'm talking about property and real estate, property and equities and commodities and bonds, the biggest proportion of asset decline in history. Nearly every asset class went down in value. In Australia, it was the worst year for stocks since 2011. So there's just no other way to paint the picture than it's pretty ugly all the way around the world, and it's not just in stocks. It's in almost every asset class. Just a quick touch on the stock and commodity trend update, and of course last week Portfolio Analyst was very topically about managing risk. American stocks down 7% for the week. That's a huge week, and we're down 18% since October. So almost a bear market definition of 20% or greater. It's been the worst December, and unless there's some miraculous recovery in the next few days, it's been the worst December since 1931, since the Great Depression. So that sort of puts things in perspective. But however, it is coming off, a pretty good period before that. I think we're probably seeing what happens when the ETF spiral, which has been fueling the market for the last 5 years or more, goes into reverse. And I've got a slide coming up next to just show you what's happening to fund flows out of those particular funds. We've also got corporate bond rating downgrades. So a lot of companies that had issued corporate debt and had some sort of A class rating on it, those ratings are now being downgraded to B ratings, which obviously leads to selling and greater stress for the company and more difficulties in borrowing. And so that's causing disruption. And then, of course, the big event of the week was the fact that the Fed is sticking to, well, it's not really sticking to its guns. It raised interest rates in December by 1/4 percentage point, which everyone was expecting, so that wasn't the drama. But the Fed had been talking about 3 rate rises in 2019. Now, the market was expecting that would come down to 1 or none, given the way that things are deteriorating throughout Europe and China, and perhaps to a degree in America as well. So they were expecting to go from 3 to 1 or 0. They went from 3 down to 2, and the market didn't like that, and that really accentuated the sell-off. And you mix that in with all the other things, the corporate bond rating downgrades, the massive fund outflows that were already underway, and it was just really the perfect storm, and took the index down 7%. Now, if the Fed sticks to their 2 interest rate rises next year, there's going to be mayhem. So I think it's highly, highly likely that the Fed will have to back off. They have said in the past that they are data dependent, so I don't think the Fed has a saving face problem with backing off if the data certainly supports that. So I think the Fed is going to have to pause, otherwise asset markets are just going to fall apart. The financial system will be in trouble. So I think that will happen, and if that does happen, then markets will rally to a degree. So we've still got a lot of uncertainty ahead. But what is helping the Fed is the plummeting oil price, which is down from 76 to 45. So that's really taking the heat off inflation, which is the whole point of the Fed raising interest rates. So if you take away the inflation issue from at least commodity prices, then you've only got to deal with the inflation issue coming from wage rises, and they haven't really manifested themselves yet. We've just got a low level of unemployment and a little bit of wage growth, but not excessive at this stage. So that's helping the Fed to perhaps not go to rate rises next year. Now, the US dollar was a little bit lower on the week because people are now betting that the Fed won't be able to raise the rates 2 more times. So that's taking the heat out of the US dollar. We saw the high yield debt ETF really plunging last week, so we'll take a look at that. And the 10-year Treasury yield fell further down to 2.79. So the cash rate is going up, but the 10-year Treasury yield is coming down. So the market is definitely betting that the Fed is not going to continue raising rates. So let's jump in and take a look at some of the charts. Start with the S&P. This was my line in the sand, the first swing low. For long-time viewers, I've done this over and over again, looking at 2000 and 2008. And when you break the first major swing low, then that is that is a bad sign, and you really have to take some more definitive action at that point. Now, as you will recall, over the recent, since we started this sell-off in October, I've been encouraging certainly all the members of my services. I've been encouraging them to basically wind back their exposure, get the cash levels up, and we've started going short in the last couple of weeks as well. So that was in preparation for what might happen. So you should have already been adjusting. But now we've clearly broken that line in the sand, and we now have a lower, what I would call significant swing low. So can't be ignored. You should either have high cash levels and or a significant covering hedging position, however way you do that, using put options or inverse ETFs or CFDs or however whatever mechanism you use to do that. Now, you will notice that the market is heavily oversold in the short term, so it wouldn't surprise me to see a little bit of a relief rally, but this level here around 25.30, that was support. It's now going to become resistance, so I can't see the rally going too far. And you'd have to say that the path of least resistance is down, and therefore lower prices are more likely than not. But I'll come back to how you should handle this towards the end in the wrap up, because this is still not a time to panic. You should have already been making adjustments. I just don't believe in making big sudden adjustments. You should have been progressively doing things over the last couple of months. And now that we've had this breakdown, it's appropriate to take a few more steps in that direction. But markets could rally and steady from here. And if something positive came out of the trade war situation between the US and China, if the Fed came out with something a little bit more accommodating, then we could see markets bounce back up into here again. And then you'd look pretty silly if you've made a massive move to orientate yourself to the downside. So do things steadily and progressively is the way to go about it. I won't bother looking at the other indices because they're all the same. The Nasdaq, the Russell, the Dow, they've all broken key support, and clearly we're in a significant correction. This is the US dollar. Went up a bit on Friday night, but net for the week it was down slightly. Now, while I'm here, let's look at HYG. So there's the high yield corporate debt market. what's called the junk bond market, and you could see the breakdown. So corporate bonds are being sold off very, very aggressively, which means that yields are going up. And that's going to cause a lot of stress for a lot of companies, a lot of corporates with carrying high levels of debt, that particularly the ones that have been employing debt to buy back their shares. They're going to be in real trouble because they've bought back their shares at elevated prices, probably to prop the share prices up so they could get nice big juicy bonuses. So they've bought their shares back at an overvalued price. They've taken on debt at low interest rates, and now those interest rates are going up. Those companies are in a lot of trouble, and they're obviously ones that have to be avoided. So that's that market. And if we look at the 10-year bond, you can see we did have a minor breakout above 3%, but that has now clearly failed, and we finished back at 2.79%. So the Fed raising cash rates, but the 10-year bond is having nothing of it, and it's going the other way. This is this picture pretty much paints the story. So this is the exodus from the US loan funds market, $2.5 billion, which was the largest outflow on the week, and that shows you the net position throughout the year. Obviously, anything above the line is a net inflow, and you can see since October it's been pretty heavy duty exodus. Aussie stocks, our dollar declined to just over 70 cents. So despite the fact that the US dollar was a little bit weaker, we went down. So that's really an indication of the trouble that global participants are seeing, and the Australian dollar always gets sold off when there's trouble. Our index lost 135 points, 2.4% for the week, but with the big fall on Friday in the US, I would expect probably more weakness in Australia on Monday, even though it's a shortened session. Now, the banks were the weakest sector on the week, but the selling was everywhere. Even places like Telstra, the safe haven high yield position, Telstra was sold quite sharply as well. And also small caps were down 18% from their October peak. So the small caps in Australia have been getting beaten up as well. And that normally happens. Liquidity dries up for the small caps, and you'll see that the prices are falling, not on big volume. It's just on really low volume. It's really a lack of buyers is really the issue, and you've just got some people at the periphery who are selling down. So let's take a look at the ASX 200. So you can see we had a support level there at 5,600. We broke that, and we finished down at 54.67. So looking very nasty, and it was really the banks are clearly in downtrend. You can see how much the 50-day and the 200-day moving averages are diverging very, very rapidly, and the price is way below the 50. But look, energy is also getting a fair old hammering as well since the oil price came off. So there's really nowhere much to hide in the Australian market at the moment. Precious metals, gold was up by $29, so it was a good formula for gold with the US dollar a little bit weaker. So we are clearly up above the 1245 level, and we've got a new uptrend underway. That's in response to greater perceived risks out there. So there's no denying what gold is doing. And if the Fed pauses, so one of the reasons that gold has been unable to get off the canvas this year and in recent years is that the Fed was raising rates or expected to raise rates from really 2016. And rising rates is not a good environment for gold because gold doesn't pay a yield. And so the bond market becomes more attractive. But the gold does do well when there's fear around. Fear of financial turmoil is positive for gold. And if the Fed is going to back off their interest rates, then we'll probably see the US dollar come down, and that'll be a positive for gold as well. So it's certainly very quickly become a much more accommodating environment for gold. Precious metals, my only reservation, precious metals tend to lead the gold price. The precious metal stocks, I should say, tend to lead the gold price in both directions. And stocks have improved a bit, but it's just not as decisive as I would have liked. It's not as decisive as we saw in 2016. So that's my only hesitation with, with piling into gold stocks at this stage. So let's take a look at gold. There is gold on a weekly basis. So a big move on Thursday, gave a little bit back on Friday, but the weekly chart clearly on a big picture level, this is 2015. We got a huge surge, and then we've been within that range defined in the first 6 months of 2016. So we've been caught in that range ever since, but we do have higher highs and higher lows, and now we're starting to head back up again. So ultimately, we need to get up here above 1380. So that's the next hurdle. We managed to get over this little one here at 1245, this little peak here. So we've now got short-term higher highs, higher lows. So we've got a short-term uptrend. We need to get above 1380. And if we look at stocks, GDX, on a weekly basis, you can see a bit of an improvement, but it's just not as robust. Look at this is 2016. Look at how stocks led the way. They went up percentage-wise a lot quicker than gold did, and they led the way. This was a huge week here. We've not seen that yet, so that's my only reservation with gold stocks at this stage. Other commodities, copper eased again a few cents. Crude oil, however, just got belted again down to the 45 level. It fell 11% on the week, and it's now down to a 17-month low. So how quickly that has turned around. It was only just a couple of months ago that crude was at $76 and looking like it was heading to 90. And with respect to crude oil, it's fear about just about everything. It's fear about growth in China, in Europe. It's fear about what OPEC is going to do. It's just, everything is sort of turned incredibly negative for crude oil. There's the spot copper chart. You can see we have eased off a little bit in the last couple of weeks. There's the inventory levels. Just had a bit of a tick up last week, but still clearly in pretty strong downtrend and at 5-year lows. There's crude oil, a big decline since the correction started in October. And if we look at it on a 1-year basis, you can see even more clearly just how meteoric this plunge has been for crude oil. So to wrap it all up, markets are now heavily oversold. It's likely we'll get some sort of rally. I think it'll be weak because we've got overhead resistance, but it's really the nature of it will tell the tale. I just encourage everybody just to be really open-minded. Don't try and be a hero and have some story to tell at a barbecue that you pick the direction of the market. That's just silly behaviour. Just remain totally open-minded, and you should be positioned for the market going down from here, but not necessarily massively so. Don't make big moves. The S&P, this is the facts at the moment. The S&P forward PE ratio is now down to 14.2, which is below both the 5 and 10-year averages for the S&P forward PE. Now, I get that the market is betting that earnings are going to fall and therefore push the PE ratio up. That's what the market is betting. However, what if they're not right? Because at the moment, the consensus view is for earnings to still go up by about 12%, which certainly justifies a forward PE of 14.2. So just differentiate between the forward projections and what the facts are. And at the moment, the facts are that the S&P index is cheap. Now, it might turn out that earnings do fall, but earnings would have to fall a long way from the current consensus for the market continue down from here. You should have already adjusted your balance months ago. I've been talking about this for ages, and certainly in detail with members. Keep your emotions in check. Don't panic. Don't guess. Don't try and guess what the market is doing. Don't make big moves quickly. Just adjust things progressively. Portfolio analyst this week. I'm taking a 2-week break over Christmas, New Year. I don't think anyone's interested in hearing from me anyway. And just once again, have a wonderful and safe Christmas, New Year period. And I'll be back with you next year. There's my contact details for anyone that wishes to communicate with me who's not a member. Look forward to seeing you next year. Cheers.